Welcome to Intro to Tax Planning. You know, I hear from accountants all the time that they struggle with how to discuss things like this with their clients and get them excited about the possibilities. For that reason, I'm going to explain tax planning just how I would explain it to some of my clients, and that's going to give you some ideas of how to talk about it. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will be too. You can hardly go anywhere these days without hearing somebody talk about the differences in tax. It seems that there's two groups of people in this country. There are those that are forced to pay whatever tax we owe, and there are those that seem to have some sort of special rules that apply to them. These are just a few of the headlines in recent weeks. And as you can see, these are companies who aren't afraid to even come out publicly and brag about how little tax they pay because it's all done legally. Would you like to know how they do it? I'm about to tell you the how. When we're doing tax planning and you're working with a business owner client, I recommend to always start with an entity analysis first. That's going to start as the framework for your tax plan. You want to evaluate whether the entity they're in currently is optimal for their situation, or if they would be better off in an alternative. Now you can modify that as you go through your plan, but at least gives you a good launching point. Then you move into what we call the 6 steps to maximizing the tax calculation. Essentially what we're doing with tax planning is we're making small changes to the math calculation that we use to calculate tax. So, just as a quick reminder, here's our tax formula. We start by adding up all income. Now, there's different categories of income, and keep in mind, even illegal income is considered taxable. The IRS really doesn't judge you, they just want their fair share. Then you begin subtracting, and we have all kinds of legal tax deductions that we're allowed to subtract so that we can calculate our taxable income. Now, there's really not a lot of magic here. We simply take our taxable income, we multiply it by the applicable tax rate, which prescribed in the tax law, and that gives us our tentative tax. Finally, in the last step, we subtract tax credits dollar for dollar until we arrive at our total tax. So what we're doing is we're sort of breaking this mathematical calculation apart when we perform tax planning. And I'm going to show you each step of this calculation as we go along so that you can begin to identify different types of strategies that you'll be learning about. So step 1 says that we add up all income. And of course, there are different types of income that are going to go into the equation. Things like earned income from a job, your business income and investment income, real estate, things of that sort. The first strategy is manipulating this part of the calculation. Since the first step is to add up all income, if the income never goes into the calculation to begin with, then of course your taxable income at the end is less, and therefore your tax is less. Now there are many ways that you can accomplish what we call income shifting. That takes the income away so that it never enters the equation, at least not in this tax year. We can accomplish income shifting between years. You've probably heard of retirement plans. That's simply an income shifting technique where we're moving income from this year. This number ends up being less, which makes taxable income less, and therefore we're paying less tax. We kick it down the line into the future. We can also income shift with people in our lives, and that can be people that are in a lower tax bracket so that you can take that income that would otherwise be taxed at a higher rate and tax it at their rate, which is often lower. And finally, we can also use entities. Again, if we move income from a 1040 tax return off onto, say, an 1120 return, it never gets added into the income to begin with. And you know the drill, then tax is overall lower. Let's talk about how to shift income with an entity. What we're doing here is we start the process off by identifying that there is an opportunity. Number one, how much will tax be reduced if in fact I lower the income on this person's tax return? Second, do they have a business? I can't really shift income to an entity if I earn my income on a W-2. Third, we have to better understand the business and how the business earns money. Most businesses have different revenue streams from different sources of activities. And what we're looking to do in shifting income is identify one of those revenue streams that would be optimal for creating a new entity. So, for example, let's take a tax business. You're probably very familiar with that. Most tax businesses earn income by doing more than one function for their clients, such as getting paid for tax preparation, bookkeeping, payroll services, etc. And we identify a separate stream of revenue that's going to be amenable to accomplishing this income shifting strategy. In this case, let's say that we identify the payroll revenue stream in order to income shift. The second step says plan to segregate streams of revenue. And all we're doing in this step is we're identifying that revenue stream that we want to redirect. In this case, it's payroll. And then we are setting up an additional entity to hold this business activity. So we go from having one business to having two businesses. We can have the customers pay the payroll business for this service instead of continuing to pay the original tax business. And effectively what we've done is we've shifted that income away, perhaps from a pass-through entity, so that it is removed from the 1040 altogether. And perhaps you set this up as a C corporation so that that income instead is reported on an 1120. Now, it gets more complicated than this, and there are many more opportunities and reasons why you might want to consider using income shifting. For example, you may want to segregate this stream of revenue for future succession planning. You may also want to separate this out because there are some items that are deductible in a different kind of entity than they are in the current choice. Whatever the reason is, income shifting, this model and this mechanism, can help provide a way to lower the top line of revenue, which is going to help reduce our tax in the long run. Now, the second strategy I want to share with you has to do with increasing the amount of deductions. Remember, we add up all of our income and then we start subtracting legal deductions. And of course, everybody wants to think that they're taking all of the deductions they're entitled to. But our research shows differently. Most people are missing out on many, many deductions that they otherwise qualify for. Now, just like income shifting, we can use expense shifting to change the timing of when we take or recognize that deduction. For example, net operating losses. There are special rules that apply when you have more expense than income in a business. And what we're doing with a net operating loss is we're capturing those expenses and moving them to another year where they might be more advantageous. Why would you want to move an expense to a different year? Really simple. Let's say you're in a low tax bracket today and you're aspiring to earn more and the business grows and becomes successful. It may be worth more to the taxpayer in the future. We can accomplish that with expense shifting. Now, in addition, we probably do this and you do this on a daily basis, but you just don't realize that you're expense shifting. When we make decisions about depreciation, for example, whether to use bonus or 179, choosing the lives and the methods in how we're depreciating, and there are lots of other ways to shift those expenses. The idea here, though, is that less deductions make our taxable income higher, while more deductions make taxable income lower and in turn reduces taxes. Now let's talk about a timing strategy with respect to depreciation as an example. Let's say you have a property, and most every tax professional is aware we can't depreciate land. And so what we do is we apportion out the cost basis of that property. What's considered the land value, we take no depreciation on. And what's considered the building or the improvements, we depreciate over 27.5 or 39 years. Now, buildings are made up of lots of different components. It's not just considered the brick and mortar, the roof, and the floor. Oftentimes there are lots of other improvements that go into that property, things like electrical, plumbing, HVAC, etc. And these items all have shorter useful lives than our 27.5 or 39 years. And so one thing you can do to boost your depreciation is use something called cost segregation. That gives you the opportunity to front load those expenses, so you're accelerating the deduction sooner so that you can save tax now and have more cash available. That's an example of expense shifting. Now, the third tax reduction strategy is what I call loopholes. Now, loopholes are government incentives to promote public policy. A few examples of this that we've seen over the last decade. One presidential term might be in favor of health care. And so what they do to incentivize people to participate in health insurance and provide health care for employees is they offer tax incentives to get the citizens to participate. You also might have a presidential cabinet that is in favor of encouraging the economy or stimulating business growth. In that respect, they create special tax incentives that allow you to start new businesses with stimulus money provided by the government. Do you see what I mean? The thing with loopholes is they tend to be temporary in nature. They're not around forever. They tend to not be permanent, which means that if you aren't aware of the loophole and you don't use it, you will lose it. So you do have to be aware during the correct time of how to use that loophole best and when. Some examples of some loophole strategies, things like the Section 1202 opportunity that allows you to sell a business for up to $10 million tax-free. Our 199A deduction, which just gives you a bonus deduction because you're a pass-through entity. Opportunity zone, which allows you to permanently eliminate capital gains when you sell your investments. COVID charitable contributions, a temporary boost on the ability to contribute to charities and recognize that deduction. And COVID retirement withdrawals. Now you'll notice the COVIDs have an expiration date. Again, that illustrates the nature of these loopholes. They come and they go, but even after they expire, new ones pop up in their place. And so it's a matter of always being familiar with what's available to your clients. One such loophole that I'd like to share with you is something called an international sales corporation. Now, this strategy is really good for businesses that export their products outside of the United States. And it can apply to businesses that you ordinarily wouldn't assume have tangible products. So things like content creators, for example, they are creating digital products that may be being consumed outside of the United States. That's the requirement, is that they are producing and creating something from within the United States and selling it overseas. Here's how this works. We have a U.S. exporter, that would be your client that is creating products, and we have the shareholder or the owner of that exporting business. You'll see here the customer. The exporter is going to continue to sell just like they always do. They'll maintain the same marketing, they will continue to try to increase sales, and they'll use traditional and typical pricing. But when we use an international sales corp loophole strategy, we form what's called a commission company. It's known as an IC disc. And IC discs have special tax features that allow them to pay no income tax on their income. So what we do is we have the owner of the exporting business set up an IC disc. Based on the amount of sales that they are selling to customers outside the United States, the IC disc receives a percentage of those total sales as a commission. The exporting business receives a tax deduction. Meanwhile, the IC disc does not have to pay income tax on that income. Does it sound too good to be true? Well, it's not if you follow the rules. The fourth tax strategy I want to share with you are what I refer to as income character conversions. Now, we have different types of income. As I was saying in step number 1, we have earned income, we have investment income, we have passive income and non-passive income. And each category of income has special tax rules that apply to it, what's deductible and what's not, and which tax rate applies. What we're doing with income character conversions is we are converting the character of income streams that otherwise would be taxed at a high ordinary income tax rate, and we're converting the character to something that pays lower tax. So, for example, with a captive insurance structure strategy, you're able to convert ordinary income into capital gains income. Capital gains pay tax rates of 0, 15, and 20%, which oftentimes is lower than the taxpayer's ordinary income tax rate, which can be as high as 37%. We can also accomplish this income character conversion with things like passive loss planning, and the IC disc is another strategy there as well. Now, the fifth tax strategy that I want to share with you is what we call spending strategies or investment strategies. And I call this group of strategies spending strategies because they require the taxpayer to spend money in order to get the tax savings. And so if the person's not willing to spend the money, they don't get the tax savings, and you kind of miss out on a tax plan as well. So the magic here really is to combine these spending strategies with other strategies so that if you have a client that's not willing to spend money to get the savings, it doesn't explode your whole plan. Now, in a spending strategy, you're probably familiar with retirement planning, and you probably well know that you can make a contribution to a retirement plan or say a pension plan, and sometimes in the hundreds of thousands and even millions of dollars can act as a tax deduction for today. But what happens if your client doesn't have the money to fund the retirement plan? Or maybe they would rather use that cash inside the business to help it grow. Again, the tactic here with spending strategies is that it's really dependent on whether or not the taxpayer wants to spend the cash in order to use the strategy. We can see this with bonus depreciation, for example, and lots of accountants recommend at the end of the year to go out and buy a new car and bonus depreciate it as a way of creating a lot of tax savings. But for the taxpayer that's not in the market for a new car or can't afford a new car, this might not be an effective way to reduce tax. So while we have a category of these different spending strategies, just be aware that they might not be the first choice to reduce tax. And finally, we look at strategy number 6, which is tax credits. And this is really where the fun comes in. Because unlike deductions, tax credits are dollar for dollar reductions right off of the tax bill. In fact, tax credits is how Amazon in 2018 not only had a zero tax bill, but instead got over $200 million in a refund from the government. Some tax credits are refundable, like in the case of Amazon, and some will allow you to reduce your tax to zero. But either way, it's very, very lucrative. Did you know there are over 1,200 different tax credits? How many of those are you familiar with? Most tax accountants aren't familiar with but 3 or 4, and so you might be missing out on some real opportunities to reduce your client's tax bill by using tax credits. Employment is an area where I see a lot of missed opportunity for reducing tax, and the R&D tax credit is a big one as well. So let me give you an example of how the R&D tax credit works. Now, R&D, otherwise known as research and development, sometimes conjures up an image in people's minds of laboratories and people wearing white coats and beakers all around. It can really apply to a lot more businesses than just labs. The magic here is really in the process in which a business owner tests and evaluates different things. Now, this can be a product that they're trying to sell, and they go through prototypes. Does version A work better than version C, for example? In this case, I want to share a story with you about a software developer. This software developer created a proprietary software, and their earnings in year 1 and year 2 were between $2.5 and $3.6 million for each year. Now, these credits are to incentivize a new product design, a new module design, or what we know as updates to software, enhancements for current products that you offer, or even testing new designs. So something as simple as redesigning the packaging for your product can qualify for the research and development tax credit. So here I have a table. We've got revenues in tax years 1 and 2. Revenue in year 1 was $2.5 million, while revenue in year 2 was $3.6 million. This software company qualified for almost $76,000 in federal tax credits the first year and $74,000 the second year. Now, R&D credits are also available at the state level depending on the state where the business is based. In this case, this business qualified as well for about $24,000 and $11,000 respectively. So check out the total credits, almost $100,000 in year 1. Now, what is the credit based on? The credit is simply based on the expenses that the business is already spending, things like salaries, materials, supplies, advice and counsel they may be getting in the process, so think business coaches and mentors. All that's required is that they go through a scientific process and document that process during the times that they're testing that product, and that can help them qualify for the credit. So without spending additional money at all, this software business got almost $200,000 in free money from the government simply by qualifying for the R&D tax credit. But how many people are missing this? Lots and lots of people qualify for this type of tax credit, but they simply go unclaimed because most people are unaware that these exist. Again, it's just based on the activities that the business is already doing. They happen to qualify for the credit, and it reduces the tax dollar for dollar. And if it's a refundable credit, you get cash back more than what you paid in. And if it's not, it just reduces your tax and wipes it out. It's pretty cool. Now, the big question that often comes up when it comes to tax planning with most tax advisors is, how do I make that transition? How do I take my reactive compliance-based business and convert it to tax advisory services? One where I approach my clients routinely with ideas like these to help them reduce their overall tax bill. You've maybe even tried this before. Perhaps you've offered the opportunity for someone to change their Schedule C into an S corporation and save $7,000 or $8,000 per year. One mistake I see a lot of tax accountants make is they simply approach the client business as usual, we're used to bringing answers to our clients. And so contacting a client or mentioning to them in your next meeting that, hey, you ought to be an S corporation and here's how much it can save you, there's not really an opportunity for that client to make a buying decision. You've just told them what they need to do. So when you want to make that switch to tax planning, it's really important that you distinguish your tax planning engagement work as a completely separate service from your compliance engagements. And to do that, it requires talking to people differently, describing your work in a different way, and even approaching people differently. For example, it sounds a lot different to contact a client and say, I've spent some time with your file and I believe I can save you between $10,000 and $20,000 this year with a little tax planning. The cost to engage me for this work is $3,000. Is this something that you would like me to do? Now what we've done is we've just described a brand new engagement. We've positioned it in such a way with our taxpayer that they understand this is not part of the regular tax preparation work that we do once each year. In fact, you can even explain how tax planning is a little different. It's really a matter of real time sitting down and looking at what opportunities are currently being missed and how we can make shifts in the business and the investments of the taxpayer to help them qualify for tax breaks that they previously didn't qualify for. What you're doing in your work is you're using tools like Intuit Tax Advisor to help you calculate what the value of your ideas are so that you can confidently approach the client and say, I know I can save you between $10,000 and $20,000. Now, once someone says yes, you can go in and refine your projections, you can do some analysis, you can explore more ways to save. But the idea is that you get that consent first before you do the major work on the tax planning side so that you know that you're both in agreement that you're going to do this work and get paid well for it. And let's talk about that for a second. You get paid well for it because you're creating spectacular results. If I can work with someone that makes $100,000 or $120,000 a year and cut their taxes by $10,000 to $20,000 a year, that's meaningful to them. They can do a lot with that money. You know, it's no wonder that the wealthy grow their wealth 21,000% faster. And that's just by cutting their taxes by 10%. You can use that money to take care of financial needs for the family or to reinvest and grow the business. So the idea here with tax planning is that we allow our customers to do a comparative analysis. Here's what I mean by that. It's almost like having two tax advisors do the work and then compare results. Now, I don't like to advocate for you working for free, so I'd never encourage you to build out an entire tax plan before getting permission from the client, an agreement that they're going to pay for that work. But you can certainly prepare an estimate, offer that work to them for a particular price, and once you have agreement, you can move forward and complete the full work that goes into that tax plan. Now, if they want to shop that around to find a better price, they're going to be contacting your competitors and they're going to say, what can you do for me? Well, I'll tell you, 80% of accountants out there are not doing and offering this service in their practice. So what do you think your competitor's going to say when they receive a call that says, my accountant says they can save me $20,000, what can you do for me? It becomes a no-brainer. So you examine that potential savings. You look for both short-term and long-term opportunities. What do you see as a possibility for the next 3 to 5 years? And also, what do you see on the horizon in terms of things and moves you might want to make now so that you can be in a position to capture those tax savings 5 or 10 years down the road? The thing I love about tax planning is that you create a very tangible return on investment for each of your clients that participate. We can actually calculate to the penny what our work is worth to them, and that makes it easy for them to make an informed financial decision about whether they want to engage you for those services, even if you want to charge more for that type of work. I hope you found today's presentation helpful, and especially giving you some ideas on how you can share this with your clients and get them eager about working with you to save tax. If you're looking for more ideas on advanced tax reduction strategies or how to convert your practice to incorporate tax advisory services, check out the website listed on the next page.